Reverse iron Condor and the option Greeks. Have you ever wondered how traders profit from big price swings in the stock market? One strategy they use is called the reverse iron Condor. This advanced options trading approach is designed to take advantage of significant price movements in either direction, along with rising volatility. So, let's break it down and see how it works and how the option Greeks come into play. A reverse iron Condor involves for options contracts that all share the same expiration date. First, you buy one out of the money call option and sell a further out of the money call option. Then, you buy one out of the money put option and sell a further out of the money put option. This setup creates two spreads, a call spread and a put spread. The goal is to profit when the underlying asset moves sharply either up or down. When you set up a reverse iron Condor, you want the price of the underlying asset to move beyond the outer strike prices. The maximum profit you can achieve is the difference between the strike prices minus the net debit you paid for the options. On the flip side, if the price stays between the sold strike prices at expiration, your maximum loss is limited to the net premium you paid. Now, let's talk about the option Greeks and how they affect the reverse iron Condor strategy. First up is delta. Delta measures how much the option price changes when the underlying asset's price changes. Initially, the combined delta of a reverse iron Condor is close to neutral because the long call and long put positions offset each other. However, as the underlying price moves significantly, delta shifts. If the price rises, delta becomes positive, and if it falls, delta becomes negative. This shift helps the position gain value from large price movements. Next, we have Vega, which measures sensitivity to changes in volatility. The reverse iron Condor is Vega positive. This means it benefits from rising implied volatility, which increases the premiums of the options you bought. This makes the strategy particularly appealing during volatile market conditions or when a spike in volatility is expected. Theta is another important Greek to consider. It measures time decay, which is the loss of option value as expiration approaches. Since the reverse iron Condor involves buying options, it has a negative theta. This means it loses value over time if the underlying price does not move significantly. Therefore, for this strategy to be profitable, you need a substantial price move or an increase in volatility before expiration. Lastly, let's look at gamma. Gamma measures how much delta changes as the underlying price changes. The reverse iron Condor has positive gamma because it holds long options on both sides. This positive gamma means the position becomes more sensitive to price movements as the underlying moves, supporting profits from large price swings. Traders often use the reverse iron Condor when they expect high volatility or a significant price move but are uncertain about the direction. It is a market-neutral strategy that profits from volatility rather than a specific price direction. To manage risk, traders carefully size their positions, set stop-loss orders, and take profits when the position reaches a target percentage of maximum gain. In summary, the reverse iron Condor is a limited risk, limited reward options strategy that profits from large price moves and rising volatility. Understanding the option Greeks, delta, Vega, theta, and gamma can help traders make informed decisions when using this strategy.